Buy now, pay later services have taken the world by storm, promising consumers the ability to buy whatever they want today and delay payments over time, often without charging interest. On the surface, it sounds like an ideal solution to manage money, especially for younger buyers who may not have access to traditional credit or want to avoid credit card interest. But behind this glossy offer lies a system designed to pull consumers deeper into debt with little awareness of the consequences. These programs have exploded into a $122 billion market projected for 2025, fueled by clever psychological tricks, poor financial literacy, and a cultural shift towards spending beyond means. What seems like a harmless way to ease financial burden can quickly trap users in a cycle of fees, loans, and missed payments. This is the story of how buy now, pay later became a financial trap for millions. Buy now, pay later services work by allowing shoppers to split the cost of a purchase into smaller interest-free installments spread over weeks or months. Companies like Afterpay, Affirm, Klarna, and Zip dominate this market. They promise quick approval with little to no credit checks, instant gratification, and the ability to get items immediately without paying the full price upfront. This appeals heavily to younger demographics. Almost 28% of BNPL users fall between the ages of 18 and 24, a group that often lacks the financial education needed to understand the full impact of these payment plans. The rise of BNPL coincides with a massive increase in consumer debt. In 2024, Americans owe over $5 trillion in non-housing consumer debt, and BNPL plays a significant role in this mounting figure. Transaction volume for BNPL services jumped from $2 billion in 2019 to $24 billion in 2021. Projections suggest it could soar to $122 billion by 2025. This rapid growth is not just a coincidence. It reflects three major shifts in consumer culture and spending habits. First, nearly everything is now financialized. Even small daily purchases, like a $5 coffee, are viewed as opportunities to finance rather than pay outright. Second, social media influences buying decisions, showcasing luxury goods and lifestyles that average consumers aspire to. BNPL makes it easy to buy these items without upfront payment. Third, the pandemic triggered a spending boom as consumers sought to reclaim experiences and possessions they missed, often turning to BNPL as a quick fix. Though these services advertise zero interest, this only holds true when consumers pay on time. Late payments trigger fees, typically ranging from $2 to $15 per missed installment, but they can accumulate to as much as 25% of the original purchase price. These fees have become a substantial revenue source for BNPL companies. Studies reveal that approximately 1 in 3 BNPL users misses at least one payment, turning what appears to be an interest-free service into a costly cycle of penalties. The way BNPL companies generate income extends beyond late fees. Merchants pay significantly higher transaction fees to BNPL providers compared to traditional credit card processors. For example, processing a $100 purchase costs a merchant roughly $2.50 when paid by credit card, but this fee can double or even triple when BNPL is involved, reaching between 4% to 6% of the transaction amount. Despite these higher fees, merchants accept BNPL because it increases sales. The option to pay over time encourages customers to spend more and purchase more frequently, boosting merchant revenues. BNPL companies also profit from data collection. Every transaction reveals detailed information about consumer behavior and shopping preferences. This data is valuable to advertisers and brands, who use it to target consumers with personalized ads and offers. Furthermore, BNPL firms bundle customer loans and sell them as financial products to larger institutions, securing profits regardless of whether the individual consumers pay on time. Comparing BNPL to credit cards clarifies why the risks are less obvious but equally serious. Credit cards require a credit check and usually involve high interest rates, averaging 19% to 23% APR if balances are not paid in full each month. Missing credit card payments results in interest accumulation and late fees, which can escalate quickly. BNPL approval is almost instantaneous and requires minimal credit screening. The absence of upfront interest may mislead consumers into thinking these are risk-free credit tools, encouraging more frequent and larger purchases without understanding the payment obligations. Take the example of buying a $1,000 smartphone. Paying the full amount upfront costs exactly $1,000. Using a credit card with a 22% APR and making only minimum payments over 5 years could result in paying nearly $1,480, including $480 in interest. BNPL offers an alternative. Pay $250 today and 4 bi-weekly payments of $187.50. On the surface, this looks affordable and interest-free. But if any payment is missed, late fees and penalties quickly increase the total cost. The easy approval and installment breakdown encourage consumers to buy more items than they can afford, often financing everyday expenses. Loan stacking is one of the most dangerous consequences of BNPL. This practice occurs when consumers have multiple BNPL loans active simultaneously. In 2022, 63% of BNPL borrowers had more than one active loan at once, making it harder to keep track of payments and increasing the risk of default. Worse, many users finance small purchases such as groceries, meals, or gas. For instance, Klarna partnered with DoorDash to let users finance food orders. Splitting a $15 meal into 4 payments of $3.75 may seem harmless, but combined with other loans, it adds to a growing mountain of debt. The BNPL checkout experience is carefully designed to encourage impulsive decisions. The BNPL payment option is often highlighted with bright colors and pre-selected at checkout. This design draws the shopper's eye, subtly nudging them to choose installment payments. Prices are split into smaller amounts to reduce the immediate pain of paying, a psychological effect where spreading out payments feels less costly than paying a lump sum. This taps into temporal discounting, the tendency to value immediate rewards over future costs, pushing consumers to prioritize instant gratification. Checkout pages sometimes include countdown timers or limited-time offers, creating artificial urgency that pressures shoppers into quick decisions. These manipulations reduce time for reflection, increasing the likelihood of impulsive purchases. While BNPL can provide financial flexibility, most consumers fail to understand the underlying costs and risks. Financial literacy remains a significant issue. Surveys show that nearly 2/3 of Americans struggle with basic financial concepts. Many BNPL users treat these services like free money, not recognizing the obligation to repay installments on time. This misunderstanding fuels growing debt and payment defaults. To avoid falling into the BNPL trap, the most important rule is to never spend more than the money you have available. Treat BNPL payments as if the funds are withdrawn immediately from your bank account. This mindset encourages careful budgeting and discourages overspending. Avoid using BNPL to finance recurring expenses such as groceries, gas, or dining out, as this behavior quickly leads to unmanageable debt. Limiting the number of active BNPL loans is essential to prevent loan stacking. Carefully track payment schedules and ensure payments are made on time to avoid late fees. If used with discipline, BNPL can help manage cash flow by spreading out the cost of large purchases without incurring interest. However, this requires strict budgeting and financial awareness. BNPL companies have built business models designed to profit, no matter how consumers perform. They collect merchant fees that are double or triple traditional credit card fees, generate significant revenue from late fees, monetize customer data by selling it to advertisers, and securitize loans to sell to financial institutions. This ensures profitability whether consumers pay on time or fall behind. For consumers, the takeaway is clear. BNPL is a form of credit that requires the same caution and understanding as credit cards. Knowing payment terms, fees, and deadlines is essential to protect personal finances. Without discipline, BNPL can lead to a debt spiral that is difficult to escape. The rapid growth of buy now, pay later reflects shifting consumer culture, technological advances, and financial desperation. Behind the promise of easy, interest-free credit lies a network built to encourage spending beyond means and profit from consumer mistakes. Younger consumers are particularly vulnerable due to low financial literacy and the appeal of instant gratification. Awareness and education remain the best defenses. Consumers should treat BNPL payments as real money leaving their accounts, avoid loan stacking, and only finance purchases they can afford to repay on schedule. Those who follow these guidelines can benefit from BNPL's flexibility, but the majority risk falling into expensive and stressful debt cycles. This breakdown of buy now, pay later aims to provide clear information about how these services work, why they become so popular, and the hidden dangers they carry. Understanding the psychology, fees, data practices, and financial impacts helps consumers make better choices. If this video has helped clarify the true cost of buying now and paying later, leave a comment sharing your experiences. Like the video to support more financial education content and subscribe for updates on money management, consumer awareness, and financial tools. Knowledge is the best tool to avoid falling into financial traps and maintain control over personal finances.